You just say that it's for the event of FX geometry,
Okay.
and you just put the date of the event. Good evening, guys. Just wondered whether you guys can hear me okay. I'm just doing a bit of a sound check. We'll be starting in about three minutes time. If you could hear me clearly as well as see my screen, I've got my presentation slide of Tickmill on my screen. If you could see that, kindly just type into the box. Let me know you can see my screen as well as hear my voice clearly. Is that okay, guys? If you can just type in there, let me just check. Brilliant. Thank you, Hardik. That's good. Okay, so you guys can hear me okay. That's brilliant. I hope you guys are all well, keeping well as well, having a good evening so far. So we'll start in about 2 3 minutes. I'll be with you guys. Do keep your questions at bay for now, and we shall get to all your questions at the end of the session. And I'll be back. Brilliant. Good. You can hear me about that's brilliant. Thank you. Thank you all. And I'll be back in about 2 3 minutes time. Okay. Thank you. Bye bye. The initial investment, please ensure you fully understand the risk and take appropriate care to manage your risk. That's it, guys. So we've gone over, like I've mentioned, 3 modules. So today is, no, sorry, 2 modules, and today is your third module. So what is your third module here? You've got third module here with the title, Geometric Pattern Basics. Okay, I'm going to be trying to lay out this course for you in the simplest form, and I'll be talking about a very interesting pattern that I found myself, but it's not mine originally, meaning that it's been tweaked from harmonic patterns and various others. So I would like to also give you some references at the end. You guys could easily go to www.fxgeometry.com to get more information on the geometric patterns as well as the methodology surrounding it. But what we will do is we will go into the basic of this and how do we use geometric patterns and what are geometric patterns. And I'll give you a very clear tutorial on understanding what the shapes are, I mean, what the price patterns are, and why do we call it geometric patterns and various others. Okay, so let's just start. Now, I hope you guys are ready for this, the next 45 minutes or so, to be with me on this geometric pattern basics. So here we go. We've got two types of pattern. I know that most of you guys would find that these two patterns are really familiar. Okay, we call it the ABCD pattern. Some people call it the lightning bolt pattern, and all these patterns, as you can see, you've got bullish and bearish right there. Okay, so you've got bullish pattern and you've got bearish pattern. And what I'll do is I'll draw these patterns out for you live on the live market on Tickmill's MT4 platform, and you shall then see how it's been drawn. But what I would like to clarify is that these patterns here, we are usually awaiting, as geometric pattern strategists, we usually wait for the pattern to actually, let's look at the bullish pattern first. Okay, so the bullish pattern right here, we usually wait for the A point to actually progress in price right up to the B point, and then it makes that correction. That correction there is a very, very important corrective move that we would like to first wait until it bounces off from the C point, at least by a few candles. But I'll describe that later on in a more practical manner using the platform itself on your MT4. Okay, so where we are trading or making that forecast or that prediction is the C to D leg, and basically very simple, your D is your target. So we're not, I'll just re-emphasize this, we're not trading the A to B leg or the B to C leg. We are trading only the C to D leg. But here we are only on a chart pattern. It's not a harmonic pattern as yet. It's not also a geometric pattern. So I'll just describe to you later on how do we actually convert, very simple, to convert this very simple chart pattern into a geometric pattern. So now we need to start with the foundation. So the foundations itself is when we start with an ABCD pattern. So here we go. I know you guys have actually attended, for those who have attended the last two, we will go into revision mode as well, looking into how you're looking at trend, using the EMA lines, if you guys can remember, 50, 100, and 200 exponential moving average and everything else. So we'll take all these pieces of puzzle and put it together so that we have got a bit of a plan on how we're going to be drawing the patterns. Okay, so here, for example, when you're looking into a drawing or spotting a bullish pattern, it needs to only be, let me re-emphasize, only be in a bullish trend. So you need to look and spot or even start drawing a bullish pattern only in a bullish trend. Okay, and likewise, if you are in a bearish type pattern, downtrend, you are only to spot and draw a bearish type pattern. So here, if we look into the bearish pattern, it's the same. We've got three legs, A to B, B to C, and C to D. C to D is your, it's the leg that you would be making the forecast on to look into targeting or your take profit area at the D point or the D zone area. Okay, so one very nice thing that I would like to say is that it all comes to being geometric once you have the lines drawn in symmetry. So this is a branch of mathematics, it's a branch of trigonometry as well. So whereby how I've actually drawn this is quite simple. when I've drawn the A to B, we will need to first go into how do you spot that A to B move, and then how do you actually go into drawing that pattern based on the A point there, and why did the A point land there, and how did the C point, we decide the C point to be C point. Now it'll all become very clear once we go onto the Tickmill MT4 platform. Okay, so here in this structure, the structure itself is quite simple, whereby your A to B length is similar to your C to D length. Okay, so how we predict the first time, or the first option in predicting the D point, is by drawing the A to B line, and you double click that A to B line on your chart, and you bring it over to this area here. Starting from C, you will get the D point to point upwards right there in a bullish type pattern. In a bearish type pattern, same manner, you draw the A to B line, and you double click that, you bring it all over here, and that would actually then help you predict the D point. But before anything else, we will always need to determine the trend on 3 time frames. That will then increase your probability and lower the risk of a failed pattern. Okay, are you guys ready now to go to the next slide? This next slide here will introduce you to the geometric pattern. The geometric pattern happens, or it's easily converted once you have drawn the A to D line. Forget about all the other lines. If you've got your A, B, C, and then D, and all you need to do is attach your A to your D, and you would actually get a geometric shape like that. Okay, and what we want to look at is that center point area right here, and that center point area would then mark your potential entry. So your entry would be above that center point to actually aim at the D point as your TP. Your center point could actually lay out a very nice zone for a potential entry point for a buy in a bullish type pattern, for a sell in a bearish type pattern. Okay, I know it may actually be a little bit new for you guys to sort of register this information, because it's completely new and completely unique. You won't be able to find this information anywhere else on Google, except for fxgeometry.com. So you could easily go to www.fxgeometry.com, and I work in collaboration with Tickmill, strictly in providing Tickmill's clients and traders with the geometric patterns basics course, as well as the mentorship program. Okay, guys, so here we go. So let me just go back to the first slide again. So that's how the pattern looks like. Now it starts off with just a chart pattern, which is an ABCD pattern. Okay, just a bit of a revision, and that's your bullish pattern right there. That's your bearish pattern right there. Okay, so it starts off with A to B leg, B to C, and then C to D. The C to D is where your prediction stands at predicting or forecasting the D point. Okay, it's the same for the bearish pattern as well. And when that stays as it is a chart pattern only, and it needs to be converted into a geometric pattern, and you do that by a single line that is drawn from A right to the D point, so that you would be then be able to be, would be introduced to the centroid area that would mark an ideal entry area. But again, the entry area with a single line that is drawn on the center point itself, or we call it the centroid, would then need to be tweaked using the principles of psychological numbers as well that we have covered recently. Okay, guys, hope that's clear for you guys. Now, don't worry if it's still going to be a little blurrish. We will then go onto the platform, and you'll be able to see me draw on the live market, spot patterns, and draw the patterns live. Just give me a second, guys. All right, let's get going to spotting the pattern first. Okay, we'll make that really simple for you guys. We're looking at, now these patterns are applicable to almost all instruments, financial instruments, whether it be stocks, equities, even Bitcoin, and anything else that you could actually put your eyes onto charts on a platform. You could easily you could easily draw the spot and draw these geometric patterns. Okay, so it's applicable to gold, silver, commodities like oil and everything else as well. Okay, and it's also applicable in all time frames. So it's quite a flexible type methodology of patterns or price patterns. It's all only made out of price. So now, if we're looking into the Euro USD, let's do a little bit of a revision. I'm not able to spot the pattern clearly with a high probability and low risk if I am not sure of the trend. So number one, we need to be very, very clear with the trend. So how do you determine the trend? Very, very simple. We need to always look at the trend first before we even think about spotting patterns by looking at 3 time frames, and you want to match 3 time frames. Okay, so meaning we need to first apply the 3 exponential moving averages, EMA lines. The first one is the 50, the second one is your 100, and the third one is your 200. So you've got your 50 EMA, 100 and 200. Now, once we apply that, let's just start with a 1 hour chart. So I will proceed in comparing the chart or the trend from 1 hour right up to the D1. You can always pick 3 consecutive time frame. You could choose your 5 minutes, 15 minutes, and 30 minutes. Remember, we covered the lot sizing as well, a bit of risk and money management, just very simply with simple formula last week. And that does actually depend on your equity. So the time frame depends on your equity. So if you've got smaller equity, it's probably best for you to start drawing the spotting the patterns and drawing the patterns based on lower time frame. If you've got medium type equity size, let's say from 1 to 3, let's say 3,000 and above or so, then you would be able to look into the 1 hour chart and slightly above. But if you got your 10,000 USD and above, then you could your equity could cushion the whole, the not the whole, but the what do you call that? The corrective move or reversals. So you could look into 4 hour or daily chart. But anything less than 500 US dollars or so, your drawings of the patterns and your analysis should be based on lower time frame, best under the 1 hour time frame, but you can actually look into a set of 3. So let me just look at a set of 3. When you want to look into trend, you could look into all of them, but when you start to draw your patterns and do the actual analysis, it's probably best to base that on your equity level. So now we are on the first step only, which is trend. You can start off with your 5 minutes right there, and then go up to your 15 minutes and just go all the way up to your daily chart. Trend analysis, you can start from the lowest time frame. That's no problems at all. So let's say, for example, I would like to look at whether or not first things first is to look at the position of the current candles right here. Look at the whole angle of candles right here. Are they actually under all 3 lines or above all 3 lines? So this is a great example of a very strong sort of downtrend in one time frame, which is the 5 minutes chart. So on the 5 minutes chart, I have got candles traveling really nicely under all 3 lines, which is a great thing. And you see the dominance of candles as well are by bearish candle. So when candles are under all these 3 lines, that actually means that it's on a downtrend bias or bearish. Okay, now the further away it is from the 3 lines, it's great to know that you've got the momentum of bearishness picking up. Okay, now that's the first thing, the position of candles. And while you see the position of candles, you need to look at the dominance of candles, meaning that you see as it goes down and go up and down, you see that there were more bearish candles with more power, longer bearish candles. So that actually gives you the idea that you've got loads of dominance. They are in control. The bears or the sellers are in control. So that's your first move, to look at the candles dominance as well as the position of candles under the 3 lines. So that's number one. Number two, you need to look into the behavior of the 3 lines. Okay, the 3 lines are made up of the 50, 100, and 200 EMA or exponential moving averages. Okay, I would like to always look at the strength of the trend is determined by the way the 3 lines are moving, meaning they should not be tangled or entangled to one another. They should be flowing smoothly, pointing towards the direction of the trend. So if the downtrend is actually persisting, or you've got a downtrend dominance, you want the three candles, the three lines, sorry, the three EMA lines to be pointing downwards as well, following the movement of the trend. Okay, so that is a smooth, nice movement separated from one another, pointing downwards. So this here on a 5 minute chart, it's a strong downtrend for the Euro USD, as simple as that. Now, if you've got a downtrend, strong downtrend, what do you do? If you come to spotting patterns, you are looking at bearish pattern only. But it's still too early to do that. I need to travel from my 5 minute chart right up to my daily chart to see whether I see the same picture. If I see the same picture as this, and the three lines are pointing down, the candles are under all three lines, that actually means that I've got a high chance or high probability to enter the trade on the downside. That actually means that my sell order would actually be more preferred than a buy order, because I am a friend of the trend. Now, when you're a friend of a trend, then you can actually spot the patterns depending on the trend as well. So you will be spotting only bearish type pattern. Okay, pattern that is pointing downwards. So here, for example, that angle of candle itself is not only pointing down, it's quite strong because of the angle of the candle. This whole movement from the very top high right here and right down here has got a very nice, we call it a 5 to 6 o'clock type angle, because if you imagine all these candles as the hand of your clock or your watch, and the 6 o'clock is right down here, right? So you've got a 5 o'clock to 6 o'clock, 5:30 to 6 o'clock type angle. Now the steeper the angle and the closer all these candles are towards the 6 o'clock type angle, that actually means that the downtrend is really strong. Okay, so that's only on the 5 minute chart that we're actually doing this. So let's go on and look at the 15-minute chart. When you look into the 15-minute chart, you can see that the same angle that we're looking at is really strong, because now it's more a 6 o'clock type angle. Yes, you've got candles under all three lines, but there is a little problem. The problem is that the three lines that you actually see has actually got entangled to one another between the 200 and the 50 moving average right there. The three lines are not moving as nice and clear to the downside as we have seen on the 5 minute chart. As simple as that. So as we go into the 15-minute chart, we still see a little bit of entanglement right there. Yeah. When we go into the 30-minute chart, sorry, the 30-minute chart has got candles under all three lines, but it did not match the way the three lines are moving. The three lines itself is telling you that yes, it's downtrend now, but this is where traders make a lot of mistake. They are entering the market based on what they could see in terms of the current candle. That is a big mistake. If you're only determining the trend based on the candle's length and then you see a downward candle, that actually is a very, very risky move. Okay, like for me, for example, the question to ask is the downtrend getting stronger? It is from weak to weaker, not week to week. Okay, because weak now could actually mean that it's strengthening later on to the upside as well. That's where your reversal happens. Understood? Yeah. Okay. So now we have got the candles under, but then you have got this problem here whereby we've got a bit of a touch right there, and then the three lines are pointing sideways. So not a good sign. That actually means that yes, you've got current candles to the downside, but you've got some non-clarity. The clarity of trend actually reduces because of the lines moving sideways, the three lines. Okay. So if you go into the 1 hour chart, you still have got all these. This is what tricks the traders. Okay, traders are most often tricked by the candles that happen, but then when you look into the three lines telling you watch out, because it's showing you all these candles going downwards, but it may not be a marathon of the trend. The trend may actually sort of reverse or correct itself very, very soon. We don't know, but it's not going to go on for very, very long, because the three lines are not pointing down, but sideways. What does sideways mean? Sideways mean uncertainty. Markets in doubt, you should stay out. That's simple as that. So as we go on to the 4 hour chart, you could see everything start changing. Okay, you could see that now the candles are in between. That single candle that you see for Euro USD 4-hour chart is in between three lines. When candles are in between three lines, it's best to stay out of the market and wait till candles go under or above three lines. Okay, so there's just simply no trade setup in terms of pattern when we were at 5 minutes right up to the 4-hour chart. Okay, yes, we have got the strong downtrend type on the 5 minutes, but then the 5 minutes, as we go on to the 15 to the 30 to the 1 hour, they had in the middle time frames here, you had some non-clarity. The trend was not clear. You had, not clear trend at all. So when you go on to the daily chart, then you find a little bit of correction coming downwards, but you still have candles majority above all three lines, and the three lines are pointing upwards, but not on a very the slopiness. It's not the slope. The angle of the slope is not that what do you call that? The angle is not high enough. I mean, it's not slopy. Okay. The angle needs to be as what you have seen on the lower time frame earlier on. Okay, so this is where we are. So here, for example, let's say an example of a pattern. Okay, if we have seen the last three, or let's say we've got a set of three time frames that have shown you uptrend, 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 and things are really clear, then we would be able to draw a very nice ABCD type pattern to the upside. So that actually means that if we are looking at an upward type move all the way from any bottom that you want, if the bottom touches one of the three lines as a good starting point. Okay, picture this any one of these line as your ground, as your grassland. Okay, so if you've got your feet on it, it's good to look into a point right here all the way up to the highest level right there. So that's your highest level. Very simple. Your low level that is on either one of the ground. The ground basically would be either the 200, the 100, or the 50 moving average. So if I take my lowest is to the wick, we want to keep it really simple, and we pull that from the low end right there to the high end right there, and we've got A to B. Now this is my A to B, and my B to C is usually the corrective move. Okay, all the way down. Now the reason why I've drawn my A to B like that, and it's a bullish pattern, is because I am seeing a potential of a bullish move. So bullish move, bullish pattern, a bullish trend, only bullish pattern. Okay, I'm just doing this as an example of how you would draw your pattern first. Okay, so if I draw my A, B, now it could easily be here as well, right down there, correct? But we will go into the intermediate way of dealing with that issue of where should I pull the A point, because you would need to be taught the Fibonacci basics first, and then we could go into knowing exactly to pull it from here or to pull it from there or any way lower. But let's just take it as here as the foot is on the ground, meaning that the A point is touching, it's really close to either one of the EMA lines. Okay, because we want to imagine the EMA lines as your ground. Okay, guys, so I've got my A to B, B to C, and I would like to know how far can the euro go up to, if at all there were to be an uptrend that gets stronger and stronger. Let's say the uptrend has picked up a bit more, and we see that this is an uptrend. We've done our trend analysis really well, so we want to predict where the D point could actually go. Very, very simple. You started with your A to B, you double click that, you bring that all the way and start that off from the C point right here. Okay, now there are ways for you to actually determine whether or not you've actually pulled it from the C point correctly, whether or not this pattern is a high probability or a low probability. At this point, just by looking at it, even though the pattern looks great and nice, I can tell you, at a glance that based on the trend that we've done, this is sort of a low probability type pattern. Okay, a high probability pattern has got its own rules and its own set of checklists that you would need to know in order for you to actually know that this is a pattern that has high probability, low risk. So I'm just going to be demonstrating to you how do you actually draw the pattern first. So I'm just going to take that off again. So you start off with your A to B, very simple. Draw your B to C line, which is right here to here, and that's your C point right there. And you take that, so that actually means your AB's length is equal to your CD's length. And this is what we do to actually predict where the D could actually go. Now, I would always like to know whether or not my C point is solid. How do you know your C point is sort of solid? Is when the C point has progressed to at least a few candles up first. Okay, because what you will need to do is to convert this simple pattern into a geometric pattern that we will do just shortly. So now, for example, you've got the C to D line, and the D point is pointing to you, telling you that this may be a place. If the uptrend picks up, there may be a possibility of Euro USD reaching this area right here. So we can then put on a horizontal line right onto the D point, and that gives you a prediction, a forecast, or a projected area for D point to reach 1.2973. Now, whether or not you would be taking this pattern or not does depend on whether it's a high probability, low risk. And how do you determine that is by the trend. Now, because the trend has not matched very nicely, that actually gives you a lower probability of this particular pattern. But I want to demonstrate on how you draw the patterns first. Okay, so now we have got A, B, C, and then D, correct? Now, how do you convert that into a geometric pattern? Very easy. You pull your A all the way to D. And now you've got a geometric pattern right there. Now, the reason for us what do you call that, converting it into a geometric pattern is mainly to find that center point or centroid area, because that center point where the B to C line has actually met or intersected with the A to D line, that gives you that center X type format right there. And at the very, very center of it, you could draw or plot a horizontal line. And once you've actually done that plot on the horizontal line, because it's pointing upwards, this would actually be an ideal or potentially an ideal buy area. So your buy area would actually be determined by the center point area. So you are buying above the center point area. So you are buying above 1.2347. But look at what's happening now. You have actually got that fall of candles, fall of a single candle coming downwards quite strongly on the daily chart. And this is mainly because we have got a less clear picture on the trend. If you're if the picture of the trend or the matchingness, if you've got most of the time frame matches the trend to be an uptrend, then you wouldn't actually be looking at this happening too much. You'll be looking at more appreciation of price upwards. So you see how the trend could actually determine whether or not whether or not your pattern could actually succeed or actually fail. All right, so once it actually come downwards, the whole candles or more candles come actually downwards and start coming into the area of the three lines, that may actually indicate a failed pattern as well. But if you have actually determined the trend strongly, you wouldn't be actually drawing this pattern here only on the daily chart, and drawing it only based on one time frame would be very, very risky, because you need at least 3, 4, or 5, even better, time frames to match in terms of trend. When you've got a match in 3 and above time frames, then your probability increases for that pattern to actually succeed. Okay, so that's basically how it works. Quite simple, right? I mean, it would include loads more tutorials and loads more participation by you guys with me on Tuesdays, which are Tickmill's market outlook. So once you are looking at that more and then joining more on the tutorials and get your videos as well, you'll be able to rewind, go back to it, and do contact your account manager at Tickmill to actually request for your video. Okay. All right. So there you go. So I hope that that's actually been quite clear for you guys. I mean, we will be going on to a few what do you call that, pairs, and we will be drawing it on a live market, and perhaps also definitely give you some trade ideas in the meantime, okay, just based on what we've actually drawn. So let's just go on to the next. Let's say we are looking into USD JPY. Let's go through some major pairs just as a practice, so you get a practical know-how, hands-on experience in drawing the pattern. So here, for example, let's say I would start off with 1 hour, 4 hour, and daily chart, but it's no harm really to go to the lower time frame, like 5 minutes, which I do as a trader. I've been doing this for more than 8 years, drawing the patterns this way. Also determining the trend. So the same EMAs that I use are exactly the ones that you see on Bloomberg, CNN, and all that. I mean, they've been using these EMA lines for quite some time. So let's start off with a 5 minute chart on the USD JPY. So USD JPY 5 minutes chart, there is a problem. What is the problem? It's unpredictability. Why? We don't actually have a clear or clarity of trend, meaning candles are in between. The price now, you see the price now with current candles, and most of the candles are in between the three lines. So I'll zoom in a little bit more, and you could see that you've got a sideways 3 o'clock type angle. So you see the market has got three emotions. You've got greed, you've got uncertainty, and you've got fear. So greed would drive market up and up and up, upwards. Okay, uncertainty, meaning that they are not prepared. Investors, traders are not prepared to break out to the upside or downside. They're still thinking, they're still accumulating price. So you've got accumulation of price right here, hinting us of the lack of clarity of trend, or because they're holding on to the trade and they're waiting for something big. So what could these people be waiting for? Maybe the NFP, maybe the economic data releases, maybe a lot of things. Okay, so these are reasons why you have got market accumulating and accumulating before it breaks out. So here is not clear in trend. So we would eliminate the 5 minutes chart, and we would just say that you've got uncertainty at the 5 minutes chart. In other words, if you see this happening and you've got candles in between all three lines, it's probably very wise for you not to draw, not to look at or analyze anything on that particular chart, because it's going to be a little bit a waste of your time as a trader, because you need to also do a bit of time management. So hence the reason it's always good for you to move on with pairs immediately after it hints you with lack of clarity of trend. You can always move on to the next chart. So on the 15 minutes chart, you've got a little bit of appreciation to the upside. Why? Because you've got candle right here. It's moving up, prices is moving up and above. You've got lots of support here as well, and you've got the three lines. I would say still the three lines are sideways. As you go on to the 30 minute chart, let's see whether you've got a bit of a change of direction. You've got a bit of appreciation still, but I don't really like the way the three lines are moving. They're actually moving sideways, and the sideways move is just communicating lots of uncertainty of the trend. Okay, so they are traders and investors are actually just holding in a little bit. They're not prepared to just pump in the money or execute trades for the right direction at that moment of time. So you've got a lot of balance of price, supply and demand balances as well at this moment of time. Okay, so as you go on to the 1 hour chart, let's see what's going on. USD JPY. Now this is very, very typical of the day or the eve of your NFP. Okay, non-farm payroll. So the non-farm payroll will be released, I would think, about tomorrow my time, Limassol time, about 3 o'clock, Cyprus time, 3 o'clock in the afternoon. So you see, that's usually a very typical scenario where you see the market moving into sideways mode, waiting. So the day before, or maybe half a day before, you would always see that that's happening before it actually breaks out. Whether it breaks out to the upside or the downside could be hinted by the way the candles are moving and the long term as well. So if you go onto the 4 hour chart, you could see that the 4 hour chart has got a very different picture. 4 hour chart, you've got candles still touching the lines right there. I would prefer that the candles are under all three lines, but here itself, you've got a high, and then you've got a low, and then you've got several other highs that found resistance. and then you've got these three lines pointing downward. So they may be for the medium term to look into biasness to the downside. But I don't actually know the results. I wouldn't actually be able to even predict the results accurately, because there's a lot of manipulation as well in the markets and things like that. But for tomorrow's NFP, there may actually be hints based on 4-hour chart or daily chart that the market is wanting to take it in which direction. And this here on the 4-hour chart is giving a little bit on the bearish type bias. So if you've got 4 hours bearish bias, daily chart quite clear bearish bias, that actually means that there may be a potential of an upside in the short term, because short term you need the upside to move on as a corrective move before it moves longer and bigger to the downside. So that actually means on the 30 minutes, 15 minutes, 1 hour, there may be a reason after on the NFP figures for market to appreciate first before it actually comes down much more, because on the medium term, which is the 4-hour chart, and the longer term, I see loads of bearish biasness. So we've got more move to the downside expected for the USD JPY, especially from about a week, 2 weeks time and above, right up to a couple of months. We still see lots of bearish type sentiment or biasness. So here on the weekly chart as well, we've got that sideways move that I don't really like, because it's just not giving me a very clear picture compared to what I see on the daily chart. On the daily chart, we could actually use this by saying that for the long term sort of things, we may be expecting downward movement for the USD JPY. Okay, hope that's clear for you guys. Yeah, so downward move, what do we actually do? Downward type move, let's imagine again, if the daily chart has actually matched very nicely with a 4-hour chart and the 1-hour chart, I always need to look at 3 time frames that has matched. If I've only seen this daily chart and I draw my pattern based on only this one chart that has got a clear picture, that is entirely up to you guys as the trader, and the risk appetite needs to be measured properly, because this would be your decision to actually take. Okay, that actually means your probability actually reduces, your risk goes up if you're only based on one time frame. Okay, hope that's clear for you guys. I'll be opening the floor for questions in about 5 minutes. So let's just draw a couple more patterns so that would actually give you a better understanding. So let's say we've got a match. 1-hour chart says that it's exactly like the daily chart, whereby the candles are under all 3 lines. 3 lines are separated from one another. So you've got a clear downtrend move. Downtrend move, you would need to spot a downward move. That downward move could be from there, could be from there, but the closer the A point is from the 3 lines, the better it is. Let's say if I take it from there, that A point is quite far away from the 3 lines, correct? But then we've got closer ones here. This point here, the high, is closer to the 3 lines. So we'll take that lowest one right here, and I'll pull it down to a significant drop whereby I see a correction. Now, I would prefer the correction or the C point there to actually touch either one of the line. But let's say this is for practice purposes. I just want to show you how you spot that A to B. So that A is right up there. Okay, B is right here. And we draw the C point right there. Okay, and once we double click that and we bring that right down here, that actually helps us predict where that at that time candles would have actually fallen to, right? So I would pull that all the way down here, double click that, and I've got an A, B, C, D, predicting the D to actually be here. Now that has actually happened already, so we would have exited there using psychological numbers as well, and we would have exited quite early, but then we've got a significant drop and we would have grabbed quite a number of pips, because if we would like to know where we could have entered at the time, you simply need to convert this ABCD pattern into a geometric pattern by doing the so-called action here from A I cross it all the way and it touches the D, projected D point. Okay. So here we've got a center point, and that's basically where I would begin looking at an ideal selling price under that line, under that rate line at 109.39 and below. So I would sell below that, but it's probably best for us to always tweak it based on the psychological numbers as well. So I would sell around there and I would take profit above that line that has been projected as well. Okay, so there, just roughly, even if I grab it around here right to there, that's about 300 plus pips, mainly because it's based on the daily chart. Okay, so once you have this on a daily chart, that actually means that you would like to predict from C to D. You could easily move into smaller time frames if you've got smaller equity, let's say less than your 5 or 10k US dollars and below. Let's say if you've got 500 or 1000, you want to be looking into your 30-minute chart, 1 hour chart, your 15, 30 minutes, and your 1 hour chart as the three time frames of where you could be drawing your pattern. Now, from the C to D, this move looks small, looks like it's a small pattern, but it's worth about 300 plus pips, just the potential of it reaching almost the D area and entering your cell under the centroid area right there. Okay, so what we could do, that movement from there to there could actually draw out smaller ABCD pattern in smaller time frame. We call it baby patterns. So that whole C to D leg, you could literally find, if the trend is clear, you would be able to find little ABCDs all the way down. Just you would be able to trade in stages based on that little ABCDs itself. Okay, and you would be able to move to, let's say, smaller time frame like this one here. Let's say it's the 15. This is the 15-minute chart right there. Let me just show you. Okay, so let's say at the time we have got just an example right here. I just want to show you an ABCD type pattern. Let's say, so you've got if it's in a 15-minute chart, we've got baby patterns, meaning the pips level are actually a bit smaller as well. So let's say if I've got price started right up there, but I want it to be here because it's closer to the three lines, right? So I've got my A, let's say there, I've got my B right here, and then I've got my C, which is starting from there. I redraw my A to B. Okay, so I could have actually predicted that area right here, which actually did actually reach sometime after that. And as you can see, it's got all this very close point of where the appreciation of price have actually happened. So I would have entered basically at the cross point as well for a sell. Okay, so here, for example, I do that, and at the very center area would actually be your rough entry area right there. Okay, we need to actually go back and revise on the psychological number principles, which is available on both module 2 as well as module 1 and module 2. Okay, mainly on module 2. So here, for example, would be entering right there. Now this would look to you visually as quite similar to the size of the one that we've seen on the daily chart. But if, for example, you were to measure from there right down to there, that's only about 30 pips. So you see 30 pips compared to 300 plus pips. Even if we look at it visually, it may actually be, oh, it's almost the same as what you've seen on the daily chart, but not really. So that's why we need to be very careful with the time frame that we actually draw our analysis on, whether it's chart pattern or anything else. It needs to actually mirror your equity level. Smaller your equity, smaller the time frame that you do your analysis on. When you do your trend analysis, you can actually start off with the lower time frames and then move that up to bigger time frames, and you just want to get an idea of the trend evolvement of the trend from lower time frame right up to the daily or even higher time frames. Okay, guys, I hope that's been not too much of a mind-boggling session. I hope it's actually a bit clear for you guys. Let's just start with another pattern. Okay, I just want to get you familiarized with the patterns first, mainly because we have got the NFP coming up tomorrow. So in the markets at the moment, it's a bit of a mixed jumble up with trends not being very clear, which is very natural when it comes to NFP or close to NFP time, or even some other major data releases. So here, for example, let's say I see that big move up, and I would like to predict and look at how far can that actually be reaching. How far can the USD CHF? CHF is your Swiss franc, yeah. So USD versus your CHF on the 4-hour chart. Let's say I would like to just go into drawing the patterns now. I can actually look at A here, B here, and C here, and then predict the D somewhere there, correct? Now, do I put it A from there or A from there? Now, usually it's probably best for us to find the A point. We've got different ways of doing it, especially advanced level. We'll use the Fibonacci, but we'll leave that one out for now. Now we'll just do the visual side of it. We want to always pick the A point closest to the three lines. So you've got A point there is closer, it's closer to the three lines than that very far A point. If I were to take A point here, the A is just too far away from the three lines. But if I were to take either one of these A point here or here, I would take the lowest one because they're almost the same. They're quite close to the three lines. I would take the lower end. So the lower one would be my A point. I would pull a line to my B point right there. So for example, I've got my A right here all the way up to the B, and then I've got my C right down here, and I'll take my double click that AB right up there. As you can see, so exactly at the price now as well. But I wouldn't say that this would be an ideal trade that I would have taken, mainly because I have not really measured. I think it was the lower line that we have chosen right there. Okay, so as you can see, you've got symmetry between AB and CD. The symmetry itself, it's actually called in mathematical language quadrilateral. So it is all measured. So if I were to, just to demonstrate the power of geometry itself, shapes, you have got a sort of a trapezium type shape right here. Okay, and this alone, once we have drawn some proper crosses like this centroid area itself could be a very significant support resistant automatically. So if I do that, as you can see, you've got price concentration. You have got price concentration there. You've got several, what do you call that? Touch points. So you see that center point right there. If I were to pull it, can you see the power of the center point itself? They were in the past. I've not done this. I've not seen it, but usually 90+% of the time when you draw, if you were to draw shapes properly on your chart based on geometric sort of principles, you're able to find that center point itself is usually is a powerful area that would be a significant support or resistance. You see, from that center point alone, you could see that there was a big appreciation of price from that area right there in the past right up to that area, and that alone was about 600 over pips movement to the upside. Of course, it took a couple of days, so probably a couple of weeks and months and all that, but you see how significant that center point of a very simple drawing is. Okay, so that simple drawing itself has got its reason of why it's been drawn like that. But if we take that away, okay, we take the bottom and the top line, it simply started with the power of symmetry itself. So symmetry itself would actually mean in mathematics, you have got triangles like that. That's one triangle, perfect triangle that has its own name as well, invented maybe thousands of years ago. And then you've got another triangle right there. So you've got two of the same shape, and that actually would give you an idea of how you could predict it as well. Okay, so that's the power of geometry that I have bumped into for quite a number of years, and I've been successfully using it to trade for myself as well as for students that have actually graduated from the Geometric Trading Institute as well. They're actually using these methods here as well. Okay, so this is just simply part of the whole method. We call it the geometric trading method, and basically this consists of drawing patterns alone only consist of about 10%, because we have got formulas for your money management side of it, and ways to actually collect intelligence data basically through geopolitical events and various others, so that we can then match it up nicely between geometric patterns with geopolitics and the greed of the market. You have three G's, okay? So the geometric, greed, as well as geopolitics. So these are areas that we mix it up into cooking special shapes like this. All right, guys. Have you guys got any questions? Perhaps I would like to open the floor for questions. So I know there may be some areas that may not actually be clear for you guys. Feel free to ask, and we can always, redraw certain lines and certain shapes as well. Any questions at all, guys? Any questions? I shall wait for you guys, and just shoot me some questions or some pairs that you would like to see, and we can then draw some magic geometric patterns right on the chart on the live market. Any questions, guys? Don't be shy. That's quite a number of you guys. So feel free. Give me some patterns. I'll give you some patterns. You give me some pairs, some instruments, and we shall then look into it. Before you guys shoot out the pairs, perhaps we can then look into gold as well. I mean, there's a lot of interest in gold. Let me just get rid of. Gold analysis. Okay, you guys can join me as well on Tuesdays. We'll do live market analysis on Tuesdays, going through trade ideas and drawing lots of patterns as well. So no questions at all. We need one volunteer followed by another few perhaps, but just one for now, and we can then start looking at a particular pair that probably your favorite pair. Okay, I think we've got. All right, Daniel has got a concern right here. Hi there. I think I've got all the questions coming up, but I've missed them, so sorry about that. I now will go back to the questions. Okay. Which time frame? We'll start off with Bocaino. Time frame is good for your $10 account. Okay. Well, with $10, probably we'll categorize that as your lower sort of equity. So lower equity, lower time frame. So I would guess that you want to look into drawing it from your 5 minutes onwards. Forget about your 1 minute at this moment of time. It's just too fast. But you could start off with between your 5 to 15 minutes for that one there. For Basley, in terms of different parameters, I have actually used the EMAs 50, 100, and 200 mainly for determining the trend. So I have, been sticking to these three EMAs for a very long time. Okay. Time frame best to use for gold basically does depend on your equity as well, Jamil. So if you're looking into gold traders, basically would look into, a bigger equity, probably to cushion up your margin as well, and to give you more protection over your margin. So you're looking into a 2K, 3K and above type account, and that would then you would then be eligible to your 1 hour type time frame. So you can then compare your trend between 1 hour, 4 hour, and daily. Okay, for your goal analysis, but I would then say that your 1,000 US dollars and above would be able to cushion you. But it does actually depend on whether you would like to follow that geometric trading method type strategy, and it's got all elements in it. So there are ways to do that. We'll provide videos for that as well very, very soon, Jamil. Okay, so let's go back to just before Bocaino. We've got Leandro. So Leandro has asked about low equity. Yes, it's the 15-minute shot. You can actually go on to lower equity, to be safe. When you come to drawing, I'm not talking about trend analysis. So if you got any amount of equity, low or high or medium, you can actually start off with your 5-minute chart right up to your daily chart in comparing and matching with the trend. But when it comes to drawing, yes, you're picking that 5 minutes, 15 minutes, and 30 minutes for example. Okay, but the thing with that is that it might actually encourage you to monitor the chart much more if you've got lower equity, because you've got lower equity, you need to go onto lower time frames. Lower time frames, lower pips. Lower pips means faster movement as well. Okay, so that does then make you, I would say, tempt you into looking at the screen much more often, and then you would have a bigger heartbeat, stronger heartbeat, faster heartbeat as well, because you're just wondering, whether or not it'll hit your TP and things like that. So it's really important for you to cushion that kind of feeling psychologically by really making sure that you've compared various time frames and you are very clear with the trend and they all match. I would say the more match you get from one time frame to the other would cushion that risk. Okay, Leandro. All right. So we'll move up next. Nazreen, you've got gray ED. Not sure what you mean by that one there. Daniel has asked about his concern or worry about a smaller time frame to determine higher time frame. This may not determine clear trend. It does actually depend on your strategy, really, Daniel. I mean, we are looking into price patterns. So if you draw price patterns, it's really different from actually your Elliott wave theory, let's say, for example, or even candlesticks, or even a scalping type method, because it does actually depend on what your strategy is. And for the geometric trading style method, I'm determining the trend, and the use of indicators are only for trend. So I literally don't use any other indicators apart from the exponential moving average. So the exponential moving average is just to help me understand the trend so that I can actually draw a more solid type pattern. And the pattern solidity of the pattern or probability of the pattern does depend on Fibonacci for me. So I don't really see that the what do you call that, going from the time frames and that, or any time frames from low to high or higher to lower would actually impact my trade as much as price action. So price action and support resistance zones, especially reversal zones, are much more in focus for me. So the risk area, especially price of entry and TP as well, is of a big concern for me, especially psychological numbers. Okay, so I mix them all up together to make me a nice enough soup, a geometric enough soup. So good ingredients make out a good dish, basically. So that has been actually quite helpful for me, Daniel. Okay, so yes, I hope that actually clarified that for you, because you've mentioned about smaller time frame to determine the higher time frame. Now, when we talk about trend, very simple time frame, you could start from lower to high when you just want to look into the trend. So I can easily go on to, let's say, 5 minutes right here. Okay, just give me a second, guys. All right. So if, let's say on a 5 minutes, I just want a story to be built up. So are my candles are going into the uncertain zone on my 5 minutes. But as I go into the 15 minutes chart, I want to look at the candles. Current candles now has moved lower. I would say more lower than the three lines right there. This is for gold, let's say. And when I go into my 30 minutes chart, and I look at the current candles again, I see that it's still moving lower and it's under the three lines compared to the 5 minute chart earlier on. So then I can tell a sort of a short story saying that gold's depreciation to the downside is much more clear than appreciation. So as I can see that, it's still on the downside as well. But the concern I have is the working of candles with the three lines. The three lines does not actually match the movement of the trend. Okay, so the three lines is sideways, candles are under all three lines, supposedly giving you a sort of a downward type movement, but then there's a mismatch between the way the three lines are moving and the way the candles are moving. The candles need to be under three lines, the three lines need to also follow the trend. In this case, if the candles are under three lines and the three lines are pointing downwards as well, then I've got a clearer picture of a downtrend. If not, the mismatch would actually make my trade a mismatch. Okay, so that would actually be not a very good thing. So here you've still got that concern. You see, so there's a mismatch right there. It's not clear. Even the three lines is telling you that you've got a very a sideways type movement trend, and that actually hints uncertainty. Okay, so as we go on to the daily chart as well, then daily chart, we've got a bit of a pickup. We've got a bit of a support right there. The three lines, not too bad, pointing slightly only to the upside. But again, the candles are touching the lines and they're not moving upwards. That actually means upwards and not touching the lines and moving upwards and far away from the three lines above or under would actually be giving you the clarity of trend. Okay, hope that clarifies it. Okay. Let's see whether I've actually missed out any question. Hi there, Nazreen. Maybe you want to collect the question again. Let me just see whether I have missed your question at the very beginning, perhaps. Where should we place a stop loss during this geometric analysis? Very good question, Nazreen. Okay. What I usually do is that we've got two ways. One very, very simple way is equalize your number of pips in profit with the number of pips for your stop loss. So if your entry to your TP is about 50 pips, then I would place my entry to my stop loss at 50 pips. This is called a one-to-one risk to reward ratio. That is number one. You can use that very easy, simple rule. Okay. Number two is I use the power of Fibonacci and I pick the 67 ratio, 67 Fibonacci retracement ratio. When you pull from your A point to your B point, you insert the 67%. That 67% level could easily be your stop loss level. And what you will find is that at 67% almost always gives you a one-to-one ratio anyway. Okay. All right. Hope that's clear, Nazreen, for you. Yeah. All right. Which is the best time frame? I think I've answered that. For Saranga, what is use chart? I'm not sure what that means. Maybe I have typed something wrongly and I've got a typo. I'm not sure. Maybe you want to clarify that. USE, yeah, or USD. Not sure. How accurate are the patterns, Kumbulani? That's a very good question, but I usually leave that to traders themselves to actually join me on my live Tuesdays webinar, because I draw the patterns live and you guys are able to then monitor the trades for the week. So it has actually been really good, but what I can tell you is that whatever I'm actually showing you now with the chart patterns itself, it's only 10% of the geometric trading method. So geometric patterns are quite different from the geometric trading method. Not different, but then geometric patterns is part of the geometric trading method. Geometric trading method includes you knowing your lot sizes, calculating it properly, going from step 1 until step 5. So what I would do is to understand the methodology itself, you guys can actually go on to www.fxgeometry.com for more information. There are a lot of free information right there, and you guys can actually easily join me and Tickmill for more webinars and tutorials to actually go through more practically even trade ideas or tutorials on geometric trading method. Okay, so I'll send that fxgeometry.com and you guys can easily join Telegram group if you wish. We've got Tickmill Telegram group as well. If you guys have got any questions, please send it to chris@tickmill.com, which is CHRIS at tickmill.com with your questions on the accounts or your questions on Tickmill's platform or anything like that, as well as whatever we have actually talked about today. So please email Chris and I shall be getting back to you with these questions. No problems at all. Okay, guys, let's just see whether I've actually missed out any question. Do forgive me if I have. Psychological Numbers by Simon Muhekeni. Psychological numbers, it's been actually covered in the second tutorial, so I would suggest you to get the to obtain all four tutorial videos, recorded ones, and do contact your account manager Chris at tickmill.com to request that. I mean, it's open for all traders as well as clients of Tickmill, and the videos are archived and will be sent to all attendees once it's requested, but it's available only to clients of Tickmill once you've got your live account up and ready. Okay, so that's basically it. How many time frame? Let's see. how many time frame to actually match? Now it's actually a very simple answer. The more the better, but the challenge is to get the match. Okay, so if you looked at all six consecutively but three actually matched, that's good enough. Okay, but what the question, the answer to that is that the concern should actually be more on the number of matches, not the number of time frames. You can look at the more the better, so that you get a sort of a storyline. But if you've got three matches consecutively, let's say not 15 minutes match with 1 hour, 1 hour match with daily. No, not like that. It's consecutive, meaning a following chart. So 15, 30, 1 hour, a running type of chart, a set of three time frames. So 5 minutes, 15 minutes, 30 minutes, they all three match, or 1 hour, 4 hour daily, they three match, these kind of matches that we're talking about. So three is your minimum, and three would actually be best. If you've got all six, that means your probability has actually increased quite a lot, and your risk has actually reduced quite a lot. Okay, I think I have actually answered most of the questions, but I'm going to go back now to the very bottom. Krishanta, you said that you're surprised. I hope you're surprised with this lesson. In a good way. Hopefully, you've learned something there. But feel free, go on to the fxgeometry.com website, join the Telegram group if you wish. You've got Tickmill Telegram group as well to join. Join both groups so I could, be of service to you guys as well, answering questions. Telegram group has been really popular among traders as well, because you can easily, send your screenshots, ask your questions, and we've got members in the groups that would actually help answer your questions as well. So do feel free to go onto the Telegram group, join us there, join the community, so that we can all share. Sharing is caring, as they say, and we basically would share, and trade together as a community of geometric trading traders. And on top of that, also on the website itself, we've got lots of information about the methodology. You've got some ideas on various other things that we have got on there. So do feel free and ask us at any moment of time. Okay. Hi there, Leandro. You've mentioned about requesting the videos. They need to pass the course. Yes, correct. Because the thing is that we have got the course specially designed in a way where it'll be set of four videos. Okay, so today's the third one, the third module. So you've got the last one next week on Thursday. So once the last one's finished next week, I'll be releasing about 20 questions for you, 20 quiz questions based on whatever that's in the videos and whatever that I've actually taught you. So once you've actually passed with an 80%, if I'm not mistaken, passing, then you would actually be eligible for the certificate. And once you have actually activated your live account, because live account means live money, demo account, demo money, right? So there you go. So here, for example, we've got some more questions here. You've missed the first session, Leandro. No worries. You can actually get the recordings. I mean, have your account open at Tickmill, become a live account holder, and what you can do then is request for these videos. All four videos you can request it for one time, and have that actually sent to you, and you could do your revision that way. But join the Tuesdays live webinar as well, because that's all live practical methods and techniques that I am showing you guys onto the live market. And with the Telegram group, we can all then discuss trade ideas that I share daily as well. Okay. All right. All right, Leandro, that's good. So let's see. Mohammed Nazreen, you've got another question on gold. Gold has shown how long can the centroid last before we enter the what's opening. OP is your opening price, is that correct? Can the pin bar at the centroid count as? All right, good, very good question. Let's say, for example, here. Now, it all boils down, number one, Mohammed Nazreen, it all boils down to the trend. Now, the pattern may look very, very nice on one time frame. Let me just go back. So it may look really nice and things, but again, it may also fail. Yeah. Now the thing is that the centroid, when you've got the candles, let's say at least a couple of candles upwards, you've got 1 2 candles, depends, but most importantly is the price. Now it does also depend on how conservative you are. It also depends on which time frame you are drawing it. If you're drawing it on a large time frame and you are conservative, let's say, you've got conservative traders who wants to place two types of trade. The first trade is right after it actually comes upwards to the center point, at least by a couple of candles. That is their first option in trading. The other one is after price has actually gone past the B point as well. So he's got, you know, two options, two entry areas by balancing one with another. Now the most important thing is that, like, let's say here, if you've got 4 hour, let's say here, if I look at 4 hour, like right here, it's actually, it's got, if I zoom in a little bit, yeah, I see that the candles are under all three lines, but the three lines are pointing sideways. So here you've got a mismatch. So I don't really like the way the trend is giving me the picture, that it's quite unclear. But then when you go onto the daily chart, you've got sort of a different picture whereby you have, let's say, a bit of a movement of candles upwards. Or let's imagine that the candles have actually moved upwards. Now, because the 4 hour didn't really match the D1, that could still be a risky type move. So you've got C point right here, you've got A right here, let's say, all the way up here is B, all the way down here is C, and then you're looking upwards. So you're looking upwards, but then you've got candles actually traveling downwards, and then you've got a mismatch at the 4 hour chart. So in other words, I wouldn't be drawing that pattern as well, because that pattern would pose as very high risk and low probability, just because the trends were not clear enough for me on at least 3 time frames. Okay, so it all boils down to that. Okay, Sebastian. Okay, Daniel's got a question here. What time on Tuesday? Tuesday, it's the same time as 7 p.m., Daniel, for the you could easily email chris@tickmill.com as well. If you've got no link for that, you can always do that. And request Tickmill to send you the link. Okay, Sebastian, would you like me to draw the GBP Yes, of course. Can draw the GBP perhaps as the last one that we'll be looking at. Let's just do that. GBP I think I've got it down here somewhere. Maybe not. Okay. There we go. So we've got GBP. Do I see it? Yes. Yeah. Okay, all the way down. Okay, so we start off with the 1 hour chart right here. Very quickly, let's say I would like to compare 1 hour, 4 hour, and daily chart. Always easy enough. You can even go down as 15 minutes or 5 minutes. There's no harm when it comes to trend. Now, with the trend itself, as I can see, you've got a bit of entanglement here. You've got the lines, the three lines, the three EMA lines are not pointing downwards, not giving you a clear downtrend picture. Also because you've got a bit of an appreciation of price coming upwards, but candles are under all three lines. But three lines are not far apart from each other, pointing downwards, smooth flowing downward type moving EMAs. They are not, so they are entangled a little bit. So that's giving you a bit of a hint that yes, candles are downwards, but there may be some non-clarity of the trend going too far. Okay, so now at this moment we go on to the 30-minute chart, let's say. Now, how about the 30-minute chart? You see almost the same type picture. You've got strong candles coming downwards, but the three lines is just mismatching with the way the candles are moving. So no clear picture of trend at this stage. And with if I zoom out a little bit, you could see that you've got a big movement downwards right here. Okay, and here itself, you know, we don't see that. We see that most traders would actually make that analysis by saying that okay, it's been making a lot of lower highs and has been going down quite a lot, you know, and it looks like it's still wanting to go through this support right here. So with the pattern, I could see a bit of a big picture as well, but then I don't see any very clear pattern at this moment of time, mainly because I have not, because some of the traders would actually do an A here and then a B here and then a C and then aiming downwards. But the thing is that I wouldn't do a pattern or spot a pattern or even draw a pattern once I'm not sure with the trend. The trend has not been, you know, really determined carefully, or it's not clear to you, then the pattern may actually pose a very high risk and low probability. So here you've got a sideways trend, you've got three lines pointing sideways, but candles are downwards. I just don't really like the way the three lines are moving. So here I've not even able to give you a bit of a bias. Now I can give you a bias of a downward type movement on a 4-hour chart, mainly because we've got lots of concentration point, found resistance here, found resistance here, broad candles under three lines. Three lines are separated from one another, which is good, but we've got candles right here, they are under, but they've just gone under the three lines, which is not too bad. But I can tell you that 4-hour chart is giving you more medium term. That means maybe a week or so after, you would find that the more biasness to the downside, maybe something may actually pressure, some events somewhere somehow would actually pressure the GBP against the JPY to the downside. But again, it's a bit too early. The angle itself is not that strong, but the bias on the 4-hour chart is to the downside. Okay, so here, for example, let's say it's a really clear downside and your 1 hour has actually matched with the 4-hour, 4-hour match with the daily. Then you can actually draw an A right here, down here. You can actually even pick an A to be right here too. That's not no problem. But then compare that A to this A here. I prefer the closer A from the you want the most recent type pattern. Okay, most recent type move as well. So there's no harm. You can pull it from there, you can pull it from here. But Fibonacci tells me where I should actually pull it from. Okay, so we'll get to that on more on the intermediate level once we use the Fibonacci to help us determine a high probability A point. Whether it's here or there, we could use Fibonacci. But I would need to cover with you the basics and the mechanics of Fibonacci using it with geometric trading method. Okay, so here you've got A right here, B right there, right? So if I take my AB and I point it right from there, because that's my C area right there. Okay, so then I'm able to predict or make a forecast that my D point could potentially fall to that level right there. Okay, so if I were to draw my A point right there all the way here, it need not be perfect. Actually, you just need to draw it from the highest point, the wick area, not the body, and then the wick again. Okay, so you've got AB and CD parallel, yeah, quadrilaterals, yeah. So then you pull your B to C right there, and you convert the ABCD into a geometric pattern right there, and you pull that right down here, and you've got yourself a geometric ABCD bearish pattern. Okay, so I just want to tidy up that a little bit. So there you go. So this is giving us a bit of a clue or a hint that your entry sell price for GBP JPY could potentially be here at the central area. The current price is really close to the central area right there. Okay, central area is at 146.57. Okay, now 146.57, I would focus on the number 57. Now this is covered, psychological numbers are covered on the second video if I'm not mistaken. So do request your video recordings so you're able to look into entry price and exit price using psychological numbers. So let's say if my 1 hour has matched with my 4 hour and daily, then I would take this trade using this pattern. If it's only my daily chart that has actually given me this hint, then I would not consider this if I were to be a conservative trader, which I am. So I would only choose high probability, low risk type patterns. Okay, so here for example, I would then sell under the 146.57. So I would convert the 57 based on psychological principles to 40. So that means my entry price would only be at 146.40, which is 10 pips under the 50 psychological numbers. Okay, so 146.40 would then be my ideal entry price for my sell, only if the 3 time frames actually matched in terms of trend. In this case, I'm just giving you an example here that this is what we actually potentially do in terms of projecting where D point could reach, only if 3 time frames have actually matched. Okay, so here for example, When it goes under the 146.57, 146.57 and under, so 146.40, now it's projected here at 143.10. Now I wouldn't be taking 143.10 using the principles of psychological numbers, because 143.10 to the upside is 143.20, which is a psychological number. So my TP would only be at 143.30. So my entry sell for my GBP JPY potentially only if the three time frames are strong, matching on all three, is to sell at 146.40 and to actually take profit 143.30. This is just an example. This is just to give you. This is by no means just giving you, trade ideas as such. But I want to actually demonstrate the use of the principles of psychological numbers to actually pick the right price of entry as well as the right price for your take profit, together with drawing the patterns as well. Okay, guys. So there you go. We've got that. Let me just see whether I've missed out any questions. Hopefully that's clear for you, Sebastian. Yusuf, is that clear? You're okay? Brilliant. Most welcome, Sebastian. Okay, guys, I think I've covered now. Forgive me if I've not covered, because we've got range of questions there. Really, really good. But scrolling upwards, I just hope I have not missed any questions right there. I think we've got a question from good evening, Sikle. Earlier on, you've asked this question. Sorry, I've missed you out. Yeah. Geometric patterns. Would you suggest limit order from B or stop orders from C? For the limit orders, you're talking about stop loss? No, not stop losses, right? Limit orders. It does actually depend whether your stop orders. Stop orders. If we talk about stop losses, then it's what I've mentioned earlier on, 1-to-1 risk reward ratio, or 67% of A to B. Your Fibonacci, pull your Fibonacci from A to B and look for your 67%. That's your stop loss area. Limit order, I'm not really concerned with that, because Sikle, what I usually do is that because we can actually spot the patterns well in advance, meaning that once it has entered the centroid, haven't entered the centroid area, but you've got your patterns drawn, you could easily do a pending order. So a pending order is my favorite. I very rarely actually trade with market orders. And I prefer personally pending orders, because you've got all your setup ready for your patterns, and if you've got your trend is strong, you have your entry price very close to the centroid area only after it passes the centroid. So you've got your entry price, and then you tweak the entry price, psychological price, you get that entry price, then your TP, you tweak it to the psychological numbers again, you get your TP price, and then you pull your Fibonacci A to B, and you get 67%. You don't need to tweak your stop loss as long as it hits your 67% of A to B Fibonacci. You take that as your stop loss. So you've got all that three, and then you enter that on a pending order, and you basically leave set and go kind of method this is actually. Okay, so it's mainly based on the pending orders. Okay, Sifle, hopefully that helps. MA Saranga, for MA, it is the EMA as opposed to just the moving average. It is applied on exponential, so it's exponential moving average, or in other words EMA, and it's applied on the 50, the 100, and the 200. Okay. Jaron has got a very good question earlier on. I do apologize for missing that out. It's about support resistance. Yes, because these are, even though I call it, some fancy name, geometric patterns and all that, at the end of the day, geometric, harmonic, or any other patterns, they are all called price patterns. So price patterns boils down to price action. Price action is only the working and mechanics of support resistance zones. So support resistance zone do refer to either video one, the first module, or the second module, to actually determine how do you actually draw a support resistant zone, not a support resistant line. So a support resistant line, if it's just a single line of support resistance, it's a really very, very risky. Okay, so I do actually see the coincidences between support resistance and psychological numbers. They actually work hand in hand. They are actually also working very nicely with the exponential moving averages that I have just mentioned, the 50, the 100, and the 200. Okay, is that all right, guys? Okay, there. I think we've covered most of it, and I'm just looking through very quickly. Perhaps I've missed I think I've missed Martin's question right here. How do I find the time to identify three time frames saying the same thing when in a day job? It's a very good question. But what I usually do as well is you could do that well in advance because hence the reason it's probably best to actually trade with a reasonable equity because a reasonable equity size would then give you more time, meaning that you're able to choose bigger time frame. Bigger time frame would give you that extra edge in actually planning your trade in advance as opposed to smaller time frame. As I've mentioned, smaller time frames meaning smaller pips, but not only that, the speed of things happening are much faster, so you may be needed to actually chase after the trend and the patterns and everything else. But then if you are looking at the 1 hour, the 4 hour in the daily, you're able to actually look at the trend, draw trend on there, and may actually take some time, especially the 4 hour and the daily chart. Hence the reason I prefer the 4 hour and the daily chart. I draw most of my patterns, more than 50+% of the time, on the 4 hour chart. But of course, after I've actually looked into most time frames, so your 4 hour chart would actually be ideal, because I've got that same problem with you as well, Martin, whereby on my job or on doing trainings and traveling and stuff like that, I would prefer the 4 hour chart, giving me time to draw that, and it would cushion me that time to draw that, so I could do that and know that my entry point centroid would only be triggered in another couple of days or tomorrow or a couple of hours time. So that gives me a bit of a leeway in terms of the time. Okay, Martin, hope that actually helps. Okay, I think I've covered most of the questions right there. I would like to. Okay, I think we've got new questions coming up. Just give me a second. One question from Sydney. Hi there, Sydney. How do you measure the 67% for stop loss? Is it the length? Actually, it's very, very simple. You have you need to insert the 67 ratio. So if you go onto Fibonacci right here, that's your Fibonacci. See, when you pull it, right, you've got on the right, you've got all these ratios, right? So these ratios are inserted they've got the default one, but then you need to add ratios in there. So one of the ratios is by adding the 67% as your stop loss. So you just double click and then you right click, you go onto Fibonacci properties, you click on add. Okay, the first column you type 0.67 like this, 0.67. Okay, the first column under the word level, the second column under the word description, you type just 67. Okay, and that's it, very simple. You click add once and then you click OK, and then you should see your 67 would actually appear as a horizontal line, part of the Fibonacci tool right there. So when I pull my Fibonacci, once you've inserted that, you pull your Fibonacci from A, okay, all the way down to B, and then you take your horizontal line and you put it right on top of the 67%, and you've got your line right there. Okay, there you go. So you have got your stop loss right there, you've got your entry right there. Potentially you need to tweak that to your psychological numbers. You would only tweak your psychological numbers based on your entry price and your TP. You don't need to tweak anything based on the 67% Fibonacci for your stop loss. Okay, so you've got your stop loss right there, entry right there, and your potential TP right there. Okay, hope that's clear, Sydney. Yeah, all right. Um, Gimafi, hi there, Gimafi. Sorry, you have asked about how do I have those yellow trend lines on my chart. Yellow trend lines. You're talking about trend. These ones here. The one that I used to draw the pattern. Very easy. These are actually just trend line right here. The slanting line that you see, you just draw it right now. I know that maybe you see that it elongated too long, right? That is because you need to double click, right click, go to trend line properties, make sure you click on parameters and unclick the ray. You may have the tick inside the box ray. Just unclick that and click OK. Then you should be able to control that line. Okay, that's the trend line there. Yeah, is that okay? You set your EMA really, really simple. You go to insert indicators and then you go to trend, you go on to moving averages. Very simple. You start off with 50. You've got 3 EMA lines that you need to apply, right? So you apply the 50, you type in the 50. Okay, the second time you apply the 100 and then the 200. So you've got three periods. Okay, 50, 100 and 200. So you start off with the 50 first. MA method, you make sure you change it to exponential. Okay, then apply to, you don't need to change that, that should remain as close. You can then put any colors you want. Okay, and you click on OK. That's it. Then you reinsert the second line. You go on the same way that I've done. You go onto trend, you go on to moving averages, make sure it's exponential. You change the numbers only on the period to 100. Everything else you don't need to change. You can change the color. You click on OK. So then you apply again the third time, and then you apply the last line of 200. So you make sure you repeat the process 3 times. Start off with 50, 100, and then 200. Hope that's clear. You guys okay? Yeah. All right. Good. So we've done that. Okay, very quickly, but last one, Jason. Yeah, USD CAD, brilliant. Okay, let's go on to USD CAD. Now this is the very last one, guys. Okay, so USD CAD. Let's just go on to USD CAD. I think it's right. The majors right there. So let me. USD CAD right there. So USD CAD, let's start very quickly. 1 hour chart first. 1 hour chart, we go into 1 hour chart. We see that it's above above the three lines a little bit right there. Okay, finding support, going upwards, a little bit biased to the upside. Three lines are pointing a little bit on the sideways, but it's got an upward slant. Let us just compare it with a 4 hour chart. 4 hour chart really very clear to the upside on USD CAD on the 4 hour chart. You've got candles above all three lines. Three lines are pointing upwards very nicely, very clear as well. You've got the price at 1.2954. Now 1.2954 or 55 is really close to the 50 psychological number. So if you are on the upside, be a little bit careful and wary, because there may actually be a potential sort of correction coming down, candles coming down at the 2950s area usually. So if you are wanting to actually buy, looking at buying price, ideal buying price should only be 1.2960 and above. Okay, because 60 is 10 pips above the 50 psychological number. So 1.29, 50, 55, 56 and all that is still in within 10 pips of the 50 psychological number. So 1.2960 and above. So need to wait a little bit for the price to go at 1.2960 and above and above. Also, if you look to the right, you have got all these resistant type area. So I have got this area to actually challenge highest candle right there, and also highest wick. Okay, so candles need to actually go up and above and break out of this two line above 1.3000. That is a psychological level that is really very significant for USD CAD. So if you want to know whether it can actually go up much more, you want to ride the uptrend, make sure price needs to go above 1.3000, because it's just a very dangerous, risky zone at this moment of time, because it is too close to the 1.3000. Okay, so if I go onto 4 hour chart and I do that, I go to the right, you see you've got a very big resistance happening at the price where we are at now. Price has actually fallen in the past at least almost 900 pips or 900 pips or so from where the price is now. So the same price where price is at now in July last year, price has actually fallen to about 900 plus pips. It took some time, of course, but that is a very big one, a fall. So you need to watch it, because the price now is really close to that area. Will it actually mirror it? Maybe mirror that big fall as well. So we need to wait till price go under 2940 and below to know that it prefers to go downwards. But again, as price comes down, let's say if you find a bearish candle, it comes down, it may also find support at either one of the EMA lines. Okay, so at this moment of time, if I were to draw, let's say I found a nice match with the trend. I've got an A to B right here. The A was here. I didn't find this as my A, because A here is just very far away from the three lines, but this one is closer. I've got a nice bounce, a C point bounce from the EMA line. Very nice. So I could have predicted the D to be around here. So I could have taken that trade once it's reached close to that area right there. So that would be an ABCD that I would have traded, let's say, but I didn't really care much of further price movement because I only care about the C to D that I am trading based on the high probability low risk trend pattern that I've actually just drawn. So I would actually take my buy around here and take my TP before it reaches that, and that's it. And I let the price of the market place on its own way. But I would take that area right there because at that time prices were, prices, if at all it matches with the three lines, they were actually above all three lines as well. Okay, and very strong uptrend. Okay. All right, there, guys. Glad that you guys enjoyed. For those who've said that it's been interesting, I appreciate that very, very much. So, Jason, hope you are happy with that USD CAD. Yeah, just be a little careful because it's in a very risky position and area at this moment of time. Too close to 1.3000 as well. It's taking its time to actually beat the 1.3000. But if prices goes under 1.29, 50 and below, like 2940 or even 2910 and below, then you would get a better hint that the market prefers a downside for the USD CAD. Okay. Okay, Tom, thank you so much for that. Appreciate that, Tom. Thank you. Appreciate that you guys find it really interesting. I do appreciate your time as well in joining me. Now, that's all I have, I'm afraid, to actually be with you guys for tonight. And I would like to say a very big thank you to you guys. Do join me on Tuesday. Tuesday is a live market presentation whereby I will go through ready-made, ready-drawn patterns and then give you some trade ideas, and you could see it on the live market as well on Tuesdays at 7 o'clock same time. And then next Thursday would be the last of this module, so it will be the last module of this course, and we will go into new topics as well at a later stage. So do join me on both Tuesdays and Thursdays. Okay, guys, I want to say a big thank you once again, and have a very good night. You guys have been great audience with loads of questions, which I really love. So do take care, guys. Have a fantastic night. Bye bye for now. Bye.